so before we jump into our next thing, I actually kind of want to show you what hyperinflation looks like a little bit. So I mentioned that, that Zimbabwe, the book talks about a little, that they had recently had a hyperinflation event. So I thought if we can pan these to if I can sit them down, pan these to the video. So these are currency from Zimbabwe, the Reserve Bank of Zimbabwe, for $100 billion and $50 billion. So I've got $150 billion right here, which is awesome. And if I had $150 billion of US money, I would not be doing these videos. But I don't. I bought these at a world festival or something, and I paid a total of $4 for these, so they were like $2 each or something like that. And I got screwed hardcore because on the exchange rate, these $150 billion would not even remotely exchange to $4. So that guy made quite a profit on those, but I thought it was worth it just to be able to contribute that to the lecture. Okay, so we've talked a lot about inflation, and I've alluded to this amount of money being pumped into society, this idea of value of money, amount of currency, et cetera, et cetera. So I think that's kind of what we want to delve into next. And again, we're really wholeheartedly in chapter 7 of our textbook now for those of you playing along at home. So what we want to do is we want to come up with a way of modeling or building a market for money. So that's what we're going to kind of think of. And I mentioned this at some point early in the semester, but we didn't draw a lot of attention to it at the time. And we've skipped the labor market and that stuff. We've eliminated that to make up for the lost week after spring break week. So I didn't really elaborate more on it at that time either, but I will now. Anytime we see this idea of some kind of market model, market makes an implication in terms of economic graphing. Any market model is going to be governed by the laws of supply and demand. So if you go all the way back to your Econ 1900 class, and you think about the law of supply and demand, it talked about the interaction of essentially price and quantity. So if we want a market for money, we're looking at, how do, price of money and quantity of money interact. So that's what we want to kind of start working on building. And we're going to take kind of a guided tour, a long way to get there and to really start doing some of the changes. But that's what we're going to look at. So the first thing I kind of thought we would talk about before we delve too far into this, just because we introduced the variable last time, is this idea of the price of money. We tend to think that the interest rate is the price of money. Like if you go and you want to take a loan out from a bank, there's something you want to buy, whether you want to buy a new car, and you don't have money for it. Well, the bank says, you can use my money. Here's $5,000, but you have to pay me back $5,500. That $500 extra that you're paying back is the price to facilitate that transaction. It cost you $500 to utilize the bank's money. So that price of money, that $500, can be expressed as a percent. Oh gosh, what was my original value? 5,000. So that would be like a 10%. It was 10% that you have to pay back in excess, or a 10% interest rate on the loan. By the way, it works the same for the savings account. Whenever you put your money into the savings account, the bank isn't just staring at your money lovingly, it's loaning it out, right? We talked about that with our circular flow diagram. They're paying you an interest rate to use your money. They're saying the price of us using your money, much lower than whatever percent I said here, that's going to be the price we pay you so that we can use your money. So the interest rate is going to effectively be our price variable in this money market. So just kind of keep that in mind, our price variable in this money market. We now want to start thinking about the idea of building the quantity of money in this market. So what we need to ask ourselves next is, as well, effectively, what is money? What are we going to include? We're going to start broad, and then we'll kind of narrow it in, and then actually we'll get it broad again. So start broad. Just a broad definition for money goes kind of beyond the idea of cash in hand, right? Money refers to any asset that can be regularly used as a medium of exchange a store of wealth and a unit of account. To be money, it must actually meet all three of these criteria. It has to be able to be a medium of exchange, a store of wealth, and a unit of account. So even though that criteria is that seems like it's a lot of checks that have to be selected before it's counted as money, that actually is pretty broad. So it does definitely go beyond the U.S. definition of money, if you will, just in terms of cash and coin. For example, in New Guinea, boar's tusk actually still meet all of these requirements. So we actually would include boar tusk as money in New Guinea. So it does allow for that broadness, if you will. The textbook gives us a fourth kind of quote-unquote requirement. Well, the fourth requirement isn't really a requirement. The only requirement to be considered money for some economic institution is that it meets these three. The textbook gives us a fourth one, which I still like. I think it is good. It gives us the idea of divisibility. That's a lot of eyes. Meaning money can be broken down into smaller and smaller kind of components. That's actually not a requirement for money, but it does make transaction facilitation easier, which is really the ultimate goal of money. It's to make the idea of a transaction a little bit easier, so you're not always exchanging, bartering item for item. You have a different method of bartering. You can exchange for money, some form. And divisibility does make that a little bit smoother, but not a formal requirement. So of our formal requirements, let me kind of just briefly tell you what each of these means. So medium of exchange, this is the one we're all familiar with. This means you can buy stuff with it. You can exchange money for an item, and vice versa. Store of wealth. This means in order to be money, it's going to have the capability of holding value in the future, whatever that may be. So if it is like a U.S. currency, if it's a U.S. $100 bill, we can use the $100 bill to buy stuff, or we can take that $100 bill and we can store it somehow, whether that's in a bank or under your pillow or whatever. And then in the future, there is relative certainty that you are going to be able to buy stuff with it then. So it has to be able to kind of hold value over time. Unit of account. I guess the best way to kind of phrase this is I guess there's two ways to phrase it, is we typically think about it in terms of it's a way of representing debt, meaning there's a value that can be owed for a transaction, and both the debtor and the debtee accept the money as a form of payment. So again, if we use the $100 bill, I could write one of you guys a note that says, I owe you $100. That piece of paper in itself is worthless, but because the dollar meets a unit of account, you can reasonably expect to receive $1 or $100, whatever it was, and I can reasonably expect to pay you $100. And that agreed upon value on the note is a way of tracking that debt. More commonly, we see that as money as being able to capture a price, because that's all a price tag is on anything. It says that you'll have this item, it has this value in exchange for money. So it kind of ties up to this one a little bit, but we do kind of separate it out because, again, we want to be able to track debt with it also. So those are the only actual formal requirements for something to be money. Once we've decided that it is money, we can break it into what we call monetary standards. A monetary standard is the method in which money is backed in the economy. The method in which money is backed in the economy. There's two types of monetary standards. There is the commodity standard, and then there is the fiat standard. So we'll start with the commodity. We'll see if we get through both of these in our time left in this video class. So the commodity standard means that the money in the economy is backed by a tangible meaning something you can physically hold, touch, feel, by a tangible item of value. The money in the economy is backed by a tangible item of value. So there are a lot of good examples, but most commonly these are going to be precious metals. It doesn't have to be, but that's kind of what we've seen a lot in history. So like, for example, the gold standard or the silver standard. At one point, the U.S. was on both of these. And if you actually go find any like really old U.S. dollars, like, from the early 1900s, you get a $5 bill, it doesn't look the same exactly as a current U.S. dollar. In fact, it probably says at the top something like $5 silver certificate. And what that meant is you actually could take that into a bank, and you could lay it down and you could say, I would like this exchange for $5 of silver. So you could actually get that tangible item, and they would give you a $5 bar or nugget or whatever of silver or gold or whatever. So it was exchangeable for some physical item. This is going to be different with the fiat standard. So fiat not referring to the Italian car, but fiat referring to the Latin phrase which is let it be. That's Latin for let it be. The fiat standard is not backed by a tangible item, but instead by a government promise of value. It's not backed by a tangible item, but instead by a government promise of value, right? So again, let it be worth $20. Well, there's nothing that backs the $20 bill. Again, I mentioned last class, it's exchangeable for a dollar's worth of material. So why is it worth $20? Because the government says so. And we all have faith in that government promise. We have faith that that bill, that $20 bill, is exchangeable for $20 worth of goods. So I mentioned the old U.S. money, right, said silver certificate. The new U.S. money says Federal Reserve note. And right on the front of your dollar bill somewhere it says, this note is value for all debts, public and private. That's it. That's the only promise you get right there from the government that says, hey, this is worth $20. They print it on the note itself. This is exchangeable for all debts, public or private. That's a fiat system. So while the U.S. was a commodity system early in its history, it has switched to be a fiat system, and has been now for several decades. So the U.S. is the largest fiat system in the world. The euro is the second largest. The euro is also a fiat system. So both of those just kind of use, again, that promise of money. It means that you don't have to have anything backing the money specifically, so it does allow for the printing of a greater amount of money than could be backed under a commodity standard. With a society that has a large number of transactions, a very large GDP, we would almost have to have that fiat system, because there wouldn't be enough money to facilitate the transactions if we were just using commodity-based standards. All right, I think that's a good spot to draw a line, because then we'll go into our next kind of liquidity categories in next class.
Your life, I didn't mean it, and I swear I know I green it, but it's hard sometimes to breathe in all the scenic. Dream of palaces and countrysides. All I want is to wake up with the morning light, laughing all alone, break away from all the city lights, hiding in the dark 'cause you don't belong.